It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, Mayor Michael Becker.
Hey, Paul.
Michael, how are you?
Doing good.
So Michael, who owns over 5,600 apartment units throughout the Dallas-Fort Worth Metroplex area, that's a lot of apartment buildings.
Yeah, we're spending in Austin right now. We're about to close on our first deal in Austin. I got one behind it as well.
So what made you go to Austin? What's the thinking on that?
You know, we've been an unbelievable run in the entire country here with multifamily pricing and kind of looking around over the last couple of years. My perspective is that, you know, Austin kind of hit a little pause maybe two and a half years ago because it's a much smaller market than Dallas-Fort Worth. I mean, Dallas-Fort Worth is about 7.5 million people, and Austin somewhere around 2 million people in the metropolitan area. And, you know, Austin has like somewhere just south of 200,000 market rate apartment units, and Dallas-Fort Worth is approaching 800,000 apartment market rate units, not excluding affordable and senior and student and all those other things. So, you know, we're just a much bigger market. But so Austin had a lot of supply delivered and kind of paused a little bit in the marketplace, and Dallas has kept going. So historically, Dallas has been less expensive than Austin, at least the last 10, 15 years. And now I'm kind of looking around at some of the pricing of the deals in Dallas, and they're very, very comparable, if not more expensive than a lot of the similar stuff in the Austin market. So it just seems like at this moment in time, you can enter Austin for similar, if not less pricing than a lot of comparable stuff in Dallas. So that makes sense to us. And then my company, my business partner, is based out of Austin as well. So we have an office in Austin. So it's the same state law as, because we're in the same state as Dallas and Austin are in the same state, as well as it's a very desirable place to be. There's a lot of vibrant nightlife scene. It's got hills, it's got water. So it's got a lot of natural beauty that Dallas is just kind of flat and goes on forever, where Austin has a lot of stuff. So it's attracting similar rates of population and migration and job growth and things like that. So it just seems like it made a lot of sense, and we're able to take 800,000 potential apartment units and make that to basically 1 million potential market rate units that we can potentially go out and buy one day. So it made a lot of sense to expand down there. And, you know, we think that Austin, you know, my crystal ball tells me we'll probably have a little bit higher growth rate in the Austin markets than even the Dallas-Fort Worth will for the next several years. But, you know, Dallas-Fort Worth is still a great place, very pro-business, much more diverse economic base than Austin. Austin's got a lot of tech and a lot of government jobs, where Dallas-Fort Worth is extremely diverse. And, you know, both are great markets. It's kind of like peanut butter and chocolate. So we've been eating peanut butter this entire time. So we're getting some chocolate down in Austin. So we're excited we're about to take, out of the gate 600, a little bit over 600 units. So I'm sure all the brokers in town will know who we are in a very short order. And I know Old Capital has been doing business in Austin for many, many years. So I don't know if you have any 2 cents on that market as well, Paul.
Well, as a parent, the University of Texas is a huge university, one of the largest universities in the country, and a lot of people, their kids go to University of Texas. Unfortunately, Austin is like a magnet because those kids typically don't return back to Dallas or return back to Houston. They want to stay within that unbelievable nightlife and technology base that Austin's really worked. That, the South by Southwest and all the music festivals that they have down there. I mean, it is tough to bring your kids back home. So Michael Becker, who has done over $1 billion in lending when he was with a large national institution, he was a lender. So he has transferred over to be an owner of multifamily properties. So we're excited to have Michael a part of the team of just giving us some great information about what's going on. Before we get into our question, Michael, what's going on with Old Capital out in California?
Oh, yeah. So we just had our meetup with our buddy JC Castillo. I believe this is going to air after that meetup on August 16th. So if it happens there before, then go check that out. But that was great. We had a bunch of people out. Real excited to be partnering with him on the Northern California Apartment Investor Network. So be on the lookout, Paul. We'll be back up there in the near term to have another event with JC for the year's over. So certainly you find out more information about that at the oldcapitalpodcast.com website. Also there, we're getting pretty close to the last call here on the upcoming second annual Old Capital Conference, September 13th, AT&T Stadium. Roger Staubach's the headline speaker. If you guys have been listening to this, you're probably sick of us talking about it, so I won't go up too much longer, but just go to the Old Capital Podcast, get your ticket. A lot of good networking. A lot of people will be there, so this is the event to be at if you're serious about multifamily investing.
So the question today for Michael is concerning a preferred rate of return for the equity. And it's kind of a timely thing because I got something as an email to me. It says that this company will be looking for accredited investors who may be interested in participating in the equity raised related to this asset. The company will be offering a 7% preferred return on capital invested as well as 75% of the underlying profits. So the question today is concerning preferred rate of returns. It was something that we've talked about in the past, but I think we want to touch upon it one more time about sponsors giving limited partners a preferred rate of return. So the question is, Michael, what do you think about these preferred rates of return?
There's no right or wrong way of doing this. And as far as the structure that you as a sponsor kind of put out to go attract capital. So whatever attracts capital is certainly no right or wrong. My company, we've from day one to even today, we've never paid a preferred rate of return. So we'll just tend to do a little smaller equity split instead of like a 75-25 or 70-30, like a lot of these people that pay a pref. We'll just do a lower split and don't pay a pref. So there's no right or wrong. I think my company would have certainly made more money looking with the benefit of hindsight with all the deals that we've absolutely killed if we would have had a graduated waterfall split. But it is what it is. And I think what we offer is a fair rate of return. My problem a little bit with the preferred equity. So to make sure no one's left behind here, the way they work is in this scenario Paul just mentioned, the sponsor is going to pay preferred rate of return of 7%. Then every dollar above the 7% is split 75-25. So if you invest $100,000 in this deal, every year you need to make $7,000. The first $7,000 is paid out to you, and then anything above that, you as a passive gets 75%. The sponsor gets 25%. So if he has enough to pay your share to pay $10,000 out that year, you get the first $7,000, and then the $3,000 split 75-25, which is great. And as a sponsor, kind of gives you some. As a limited passive investor, limited partner, kind of gives you a little bit more surety that you're going to get paid out on this deal because you're just preferred in the capital structure. But really, the struggle from the sponsor standpoint, what puts these deals a little bit at risk, in my opinion, kind of thinking through it, is if we're in a scenario where year one they're going to pay a 7, but the deal can only cash flow 4 or 5. Then if he can't pay the 7 current, he can only pay 5 current. Then the 2% is accrued and carried forward. So then the next year, for the sponsor gets a chance to make any of the profit in the cash flow, he's got to catch up the 2 plus the 7. So he's got to do 9 before he can ever see a dollar paid to the sponsor. And then if he can't do it again, and say he's got a worse year, you hit a recession and he can't pay anything out, then he's got the 2 plus the 7 plus the 7 the next year, and it kind of snowballs and snowballs. So the kind of the analogy I'll use is, the sponsor's kind of digging a hole with that preferred return, and then he's going to kind of keep getting deeper and deeper in the hole, looking out, saying, man, there's no way I'm ever going to catch up my preferred if you hit a recession and you don't pay it out for 2 or 3 years. And then his motivation as a sponsor gets a little disaligned with what the passives are in the deal. And so it could potentially put the investment at jeopardy, or the sponsor's going to make different decisions than he would if he didn't have a preferred rate of return. I think not having the preferred kind of is more a perfect alignment of interest than having the preferred from the sponsor to the passives, which is kind of why I've chosen to go that route and just take a little less on the split. So there's no right or wrong answer to it, but those are some of the thoughts that I have, especially now that these deals are getting a little bit tighter. The cap rates are compressed, so the treasury's up a little bit, so there's not quite as much positive arbitrage as has been the last few years. So those are just some things I think about when I'm putting these together. So I don't know if that answers your question, Paul, but that's just some of my rambling thoughts about it.
It does to a certain extent, because when you buy into these transactions as a limited partner, you're looking for if I invest my money into this deal, what am I going to get? Now, if you get an artificial rate of return of 7%, and if you look into the fine print that the property is only generating a 5% cash on cash rate of return, just like Mike said, the property itself is going into a hole, and you keep doing that for a couple of years, I would be concerned that they're artificially giving you a rate of return it's really not the property's able to generate. So, and I'm surprised down the road that Freddie Mac or even Fannie Mae hasn't said anything about that, where Mike's point is that now you're starting to do things maybe not for the right thing of the partnership or the collateral, because you're putting an undue burden on the collateral. You're trying to, if the property needs a roof replacement or needs to have money put into the flooring of the property or a new parking lot, because you're now in a hole, and you got to pay your investor something, I think the property or the collateral suffers if you are legally bound to pay that preferred rate of return. So I agree with Michael. It's the interests are not aligned, and I can't believe that this period of time in this cycle that Freddie Mac or Fannie Mae hasn't put their foot down saying, listen, we're putting up 75, 80% of the capital stack. We want to make sure that the collateral which is a living, breathing machine, that money has to be put into it, that we want to make sure that we get our money put into the property and that the investors don't get their money first. Anything more to add to that?
No, yeah, just pay attention to it. I mean, it's certainly more attractive from certain respects as a passive to have that preferred return in there.
I get it.
Since it gives a little, perceived your payout is an order of preference, so maybe it makes it a little bit more secure from that perspective. But at the same time, it certainly has the ability to disalign interest pretty quickly. And then, the last thing you want to do as a passive is have your sponsor, your lead on the deal, get disincentivized to pay attention to the property, to operate the property in the best interest, and make them make certain decisions that might not otherwise be the case if your interests weren't disaligned, like it has a potential of doing, for sure.
Absolutely. So some great information. Thanks, Michael. If somebody wanted to get more information about what SPI does, what's the best way of getting hold of you? Sure.
The easiest way is to simply go to our company's website, which is www.spiadvisor.com. That's SPI like spy advisor.com. There's a contact us form. Fill that out, and I'm always happy to have a 10 or 15-minute telephone call with the listeners of the podcast.
Great information. Thanks, Michael. Again, Michael Becker. I'm Paul Peebles. Have a great day.